Hong Kong Takeda Pharmaceutical Co. on Tuesday reached an agreement to buy Shire PLC, capping a months-long battle for control of the European drug maker and marking the biggest ever overseas acquisition by a Japanese company. Shire's board agreed Takeda could buy it at £49 and 1 penny or $66.21 a share, $30.33 in cash and 0.839 of a Takeda share for each Shire share, in a deal that valued the target at $62 billion. Both companies still need shareholders to sign off. The acquisition would create the world's 8th largest drug maker with combined sales worth $30 billion, and bolsters Takeda chief executive Christoph Weber's mission to gain a greater foothold in more lucrative markets such as the US. Europe. Takeda, Japan's largest drug maker by sales, said it would borrow cash to fund the deal, worrying some shareholders that it was piling on too much debt. Last year, it borrowed money to acquire U.S. cancer company Shire Pharmaceuticals Inc. for $5 billion. The Japanese company's shares were up more than 3% on the news Tuesday. But they have fallen more than 16% since late March, when Takeda first expressed interest in Shire, the Dublin-based maker of rare treatments, offering to buy it at £44 a share. It has since upped its bid 4 times. Shire shares, meanwhile, were up more than 4% Tuesday and have gained more than 13% since late March, further widening the gap between the company's market valuations. Its market value now exceeds Takeda's by almost $15 billion. Takeda said it expects to close the deal in the first half of 2019, after which it plans to list the combined entity on the Tokyo Stock Exchange, where Takeda is currently listed. In a conference call Tuesday, Mr. Weber acknowledged the deal had created lots of anxiety among shareholders. Still, he said he was confident they would vote in favor, viewing it as an opportunity to create a very competitive company for the future, despite the short-term financial risks. Drug companies see acquisitions as a quicker way to replenish their pipelines over costly and risky research. Like its rivals in the West, Takeda, founded 237 years ago, is faced with a shrinking pool of patent-protected products. The Shire acquisition adds drugs like Cinryze and Elaprase to Takeda's portfolio, helping it tap into the market for orphan drugs, which treat rare diseases and command high prices. Takeda's unrelenting pursuit of Shire shows how ardently Japan's legacy companies are chasing growth overseas, weighed down by a shrinking population and, in the case of drug companies, unfavorable government policy. In an effort to contain ballooning healthcare costs, Prime Minister Shinzo Abe's administration is encouraging the sale of cheaper copycat drugs, while imposing a cap on the price it pays for newer treatments that generate billions of dollars in sales for companies like Takeda. The Shire deal means Takeda will now earn roughly half of its revenue in the U.S., where companies have greater flexibility to charge what they like, up from one-third previously. It caps a string of smaller acquisitions for Takeda, and also tops SoftBank Group Corp's $32 billion acquisition of UK-based chip designer ARM Holdings plc in 2016, which, until now, was the largest overseas acquisition by a Japanese company. Write to Pritika Rana at pritika.rana@wsj.com.